There is a difference between a state that is struggling and a state that is collapsing. A struggling state has problems it is working to solve. A collapsing state has problems that are working on it, compounding year over year, feeding each other, moving in a direction that no single budget cycle is positioned to reverse. The states on this list are not the ones that make the national news for their crises. They are not the ones with dramatic headlines. They are the ones where the collapse is structural, built into the pension math, the tax base, the infrastructure, the demographic trajectory, and where the gap between the story the state tells about itself and the documented financial reality has been widening for long enough that it has stopped being a warning and started being a condition. Every number on this list comes from the Pew Charitable Trusts, the Reason Foundation, the Center on Budget and Policy Priorities, Truth in Accounting, and verified state fiscal data. This is not opinion. This is accounting. Subscribe now because number 1 on this list has the most documented, multi-layered, simultaneous collapse of any state in America, financial, infrastructural, and demographic. And it is still described in most national coverage as a poverty story rather than a structural failure story. Those two descriptions are not the same thing. Let's count it down. Number 10, Louisiana, the state that has run on oil money, one-time gimmicks, and borrowed time for 40 years. The bill is coming due. Louisiana's structural budget problem is older than most of its current elected officials. 40 years ago, mineral revenues from oil and gas comprised more than 40% of the state's tax base. By the time of Louisiana's 2024 to 2025 executive budget, that share had fallen to roughly 5%. The tax base that built the state's government has not been there for decades. The spending that tax base once funded has never fully adjusted to match. The result is a pattern the state's own fiscal documents describe plainly. Louisiana has spent years draining trust funds, selling property, refinancing debt, and relying on one-time revenues, legal settlements, tax amnesty programs, federal windfalls, to pay for recurring annual expenses. The Louisiana executive budget for 2024 to 2025 acknowledged that the budget reflected a $3.3 billion reduction from the prior year, primarily because the federal pandemic funds that had masked the underlying shortfall had run out. The state faced a projected shortfall of at least $587 million for fiscal year 2026, driven in part by automatic tax cuts scheduled to take effect. A decrease in the state sales tax rate expected to cost $455 million annually, along with other revenue reductions. Louisiana's structural deficit is not a product of bad luck. It is a product of a revenue base that was never replaced when the oil money left and a spending structure that was never adjusted to reflect what remained. Living in Louisiana is like inheriting a beautiful house on an income that was built around an oil well and discovering that the well has been declining for decades while the maintenance bills have been paid with money borrowed against it. Number 9, West Virginia, the largest revenue decline in 25 years, a $400 million shortfall. A structural deficit projected to reach nearly $500 million by 2033. West Virginia entered 2025 facing a budget shortfall of $400 million, a figure that followed what the Center on Budget and Policy Priorities described as the state's largest year-over-year revenue decline in 25 years, outpacing even the revenue drop during the Great Recession. The proximate cause was a combination of stagnant population growth, which limits the tax base, and the accelerating effect of income tax cuts enacted in recent years. The state balanced its 2025 budget with one-time funds, modest spending cuts, and flat funding across most agencies. One-time funds for a recurring shortfall. That is the definition of a structural problem treated as a temporary one. The Center on Budget and Policy Priorities projects West Virginia's structural deficit at $397 million by fiscal year 2027, rising to $493 million by 2033, a gap between recurring revenue and recurring spending that will need to be closed by either cutting services the state's aging population depends on or reversing the tax cuts that created the gap. West Virginia's population is the oldest of any state by median age. It has the lowest labor force participation rate in the country. It has lost population every census decade since 1950. Its structural fiscal gap and its demographic trajectory are pointing in the same direction. Neither is moving toward resolution. Living in West Virginia is like running a business whose costs are growing because the customer base is aging and whose revenue is falling because the tax cuts were passed before anyone ran the math on what they would cost in year 4 and year 7 and year 10. Number 8. Kentucky. The second worst pension system in the country. 54% funded. $40 billion in unfunded liabilities. Still cutting taxes. Kentucky's public pension systems are 54% funded, the second worst funded ratio of any state in the nation, behind only Illinois, according to Reason Foundation's 2025 Annual Pension Solvency Report. 54%. That means the state has roughly 54 cents for every dollar it has already promised to public workers and retirees. The other 46 cents do not exist yet. Kentucky carries approximately $40 billion in unfunded pension liabilities, with $8,626 in pension debt per capita, one of the highest per-person pension debts of any state. Kentucky has also been reducing income tax rates in recent steps, with each reduction shrinking the revenue base available to close the pension gap. The Center on Budget and Policy Priorities 2024 analysis on state tax cut fallout specifically flagged Kentucky as a state where the combined effect of pension underfunding and tax revenue reduction creates compounding long-term pressure. 2 school districts in rural Appalachian Kentucky have reportedly turned to borrowing just to make payroll. The gap between property tax revenues in high-value and low-value counties, a documented inequity, means that fixing underfunded schools requires either a statewide revenue solution or a structural acceptance that some districts will not have what they need. Living in Kentucky is like carrying a debt you inherited and paying it down more slowly each year while taking out additional credit in the form of new tax cuts and calling the combination a sound fiscal strategy. Number 7. Connecticut. The taxpayer burden is $44,500 per taxpayer. The pension system is 59% funded. The long-term deficit has run for 15 years. Connecticut's fiscal condition is one of the most thoroughly documented structural deficits in the country. The Pew Charitable Trust's 15-year analysis of state revenue versus expenses, covering fiscal years 2009 through 2023, found that Connecticut's revenues covered 99% of its expenses over that period. On an annual basis. For 15 years. A state spending more than it takes in every year for 15 consecutive years does not have a budget problem. It has a structural condition. Truth in Accounting's 2025 Financial State of the States report calculated Connecticut's taxpayer burden, the share of the state's debt that would fall on each taxpayer if all liabilities were paid today, at $44,500 per taxpayer. That figure is among the very worst of any state in the country. Connecticut's public pension system is 59.5% funded, according to Reason Foundation's 2025 data. Better than Kentucky and Illinois, but still well below the level at which pension systems are considered fiscally stable. The state's own long-term budget assessment projected that motor fuel tax revenues would raise less money in fiscal 2028 than they had in fiscal 2024. A structural revenue decline built into the transportation funding formula. Connecticut is not a poor state. The median household income is among the highest in the country. That is precisely what makes its fiscal condition unusual and underreported. Wealth and structural insolvency are not mutually exclusive. Connecticut is the proof. Living in Connecticut is like being a household with a high income, a high mortgage, a large pension obligation, and a habit of spending slightly more than you earn every single year, and describing the situation as fine because the income is high. CTA. Stay with us. The 5 states ahead are where the fiscal collapse is the most severe, the most structurally embedded, or the most quietly ignored, despite years of documented evidence. Number 1 has a capital city where the water infrastructure has been described as crumbling since before most of its current residents were born. Keep watching. Number 6, Maryland. A $1 billion structural deficit today. $5.9 billion by 2030. The state calls it structural. The headlines have not caught up. Maryland's Department of Legislative Services published a budget assessment that the state's own officials describe using a specific word: structural, not cyclical, not temporary, structural. The state faced a cash and structural deficit of more than $1 billion for the current fiscal year, according to the department's analysis. That gap more than doubles in the following 2 years. By fiscal year 2030, the deficit is projected to reach $5.9 billion. Maryland carries approximately $31 billion in unfunded pension liabilities and $9,400 in pension debt per taxpayer, according to Truth in Accounting's 2025 data. Multi-State's 2025 state fiscal analysis confirmed Maryland among the states facing significant short-term fiscal challenges, alongside Colorado, Illinois, New Jersey, New York, Pennsylvania, and Washington. Maryland's deficit projections are notable not because they are the largest in absolute terms, but because the state has explicitly identified the gap as structural, meaning it cannot be closed by aiding for the economy to improve. It can only be closed by policy decisions that reduce spending, increase revenue, or both. Maryland has a highly educated population, a federal government employment base, and one of the highest median household incomes in the country. None of those advantages have prevented the structural gap from widening. Living in Maryland is like having a job that pays well, a retirement obligation that costs more each year, and a budget that closes itself on paper by reclassifying some of the debts as future problems. Number 5. New Jersey. The worst long-term structural deficit of any state. 15 years of spending more than it takes in. Taxpayer burden $44,500. New Jersey holds the most documented long-term structural deficit of any state in the country. The Pew Charitable Trust's 15-year revenue versus expense analysis found that New Jersey's revenues covered only 95.6% of its expenses from fiscal year 2009 through 2023, the worst ratio of any state. That is not one bad year. It is 15 years of consistently spending more than the state collects. New Jersey's unfunded pension liabilities stand at approximately $92 billion, among the highest in the nation in absolute terms, according to Reason Foundation's 2025 data. The pension system is 55% funded. The Truth in Accounting 2025 report calculated New Jersey's taxpayer burden alongside Connecticut at $44,500 per taxpayer, the highest of any state in the country. New Jersey is not poor. It has one of the highest median household incomes in the country. Its fiscal condition is the product of decades of promises made to public employees and retirees that exceeded the state's ability to fund them, a choice that accumulated over administrations of both parties and that compound interest has been magnifying ever since. The Center on Budget and Policy Priorities identified New Jersey as one of the states where corporate income tax revenue underperformed its long-term trend, adding revenue pressure on top of a spending structure that was already unsustainable. Living in New Jersey is like co-signing a loan every year for 30 years on behalf of a retirement obligation that is now larger than most state budgets and still calling the balance sheet manageable because the property values are high. Number 4. Hawaii, more deaths than births. Seniors outnumber children since 2020. A revenue forecast showing tax collections declining 3.5%, an economy entirely dependent on tourism and geography. Hawaii's fiscal fragility is structural in a way that most states' problems are not. The state's tax base depends overwhelmingly on tourism and trade, two sectors that can be disrupted by events entirely outside the state's control. When those sectors slow, Hawaii's revenues fall faster and recover more slowly than states with more diversified economies. The Center on Budget and Policy Priorities 2025 State Budget Roundup reported that Hawaii's Council on Revenue's projected state tax collections would decline by 3.5% in the fiscal year beginning July 2025, followed by growth of just 1% the following year, well below what is needed to keep pace with rising expenditure demands, particularly in Medicaid and aging-related services. Hawaii's pension system is 63% funded, carrying $9,784 in pension debt per capita, one of the highest per-person burdens in the country, according to Reason Foundation's 2025 data. Pew's 15-year fiscal analysis found Hawaii among the 5 states with a long-term structural deficit, with revenues quota varying only 99.1% of expenses from 2009 through 2023. Hawaii also crossed the threshold into having more seniors than children in 2024. The state that depends on a young, working tourism workforce for its tax revenues is producing fewer and fewer of the young workers that workforce requires. Geographic isolation compounds everything. Almost everything the state cannot produce must be shipped across more than 2,000 miles of ocean, at a cost determined by fuel prices, supply chains, and global conditions that Honolulu cannot control. Living in Hawaii is like owning a paradise whose maintenance costs are determined by the mainland and whose revenue depends on people flying across an ocean, and calling the math sustainable because the views are extraordinary. Number 3. Alaska. Oil revenue, down 46.5% in fiscal 2024. Primary budget reserve, projected empty by 2027. A state that has not yet replaced the economy it has. Alaska's fiscal structure is unlike any other state in the country. The state has no personal income tax, no statewide sales tax. Its budget depends overwhelmingly on oil severance revenues, a stream of income that has been declining as North Slope production falls and as global energy prices fluctuate. In fiscal year 2024, Alaska's tax revenue fell 46.5%, the largest single-year decline of any state, according to Pew Charitable Trust's data. That decline was driven by falling energy prices and reduced oil production. The state's permanent fund, a sovereign wealth fund built from oil revenues, provides investment income that supplements the budget and pays annual dividends to residents. But the principle of the permanent fund is constitutionally protected. It cannot be spent. Pew's 2024 long-term budget assessment analysis flagged a January 2024 legislative report projecting that, absent policy changes, Alaska's primary budget reserve could be empty by fiscal 2027. 3 years. Empty. Alaska has the tools, in theory, to address this. A personal income tax would generate significant revenue. Reducing or restructuring the permanent fund dividend would free up state resources. Both options have been politically difficult to move through the legislature for years. The state has chosen to wait. The reserve is not waiting. Living in Alaska is like sitting on top of a mineral fortune you can see but not spend, watching the checkable account run down, and debating whether to solve the problem before or after it solves itself. Number 2. Illinois. The worst-funded pension system in the nation. $201 billion in unfunded liabilities. $15,804 in pension debt per taxpayer. More than any other state. A projected deficit of $5.1 billion by 2030. Illinois has the worst-funded public pension system in the United States. 52% funded. Dead last among all 50 states for the second consecutive year, according to Reason Foundation's 2025 Annual Pension Solvency Report. The state's unfunded pension liabilities total $201 billion, the second largest in absolute terms of any state, behind only California. $15,804 in pension debt per capita, the single highest per-person pension burden of any state in the country. State pension contributions have grown from $614 million in fiscal year 1996 to $11.2 billion in fiscal year 2025. That is not a trend. That is a nearly 20-fold increase in a single budget line that now competes with education, healthcare, and infrastructure for the same limited pool of general revenue. Illinois property taxes are the second highest in the nation, in part because local governments have had to compensate for state fiscal constraints with their own property levies. Illinois is also projecting a general fund deficit of $3.2 billion in fiscal year 2026, growing to $5.1 billion by 2030, according to Multistate's 2025 analysis. That deficit exists alongside the pension obligation. They are not the same number. They are two separate problems occurring simultaneously in the same budget. Illinois has made genuine recent progress. Credit ratings have been upgraded. The backlog of unpaid bills, which once reached $17 billion, has been substantially reduced, and the progress is real. But in the same year that progress was being made on the backlog, pension debt grew by another $1.5 billion. Living in Illinois is like bailing out a boat while the leak is getting larger, and measuring success by how dry the deck is at the end of the day, rather than whether the boat is still floating. Number 1. Mississippi. The capital city went 48 days without reliable drinking water. The pipes were installed before the Great Depression. The pension system is 56% funded. The state just cut $2 billion in tax revenue over 5 years, the lowest median household income in the country, the highest poverty rate, and nobody has called it a collapse. In the summer of 2022, Jackson, Mississippi, the state capital, home to approximately 160,000 residents, went 48 days without reliable drinking water. The water treatment plant failed. The pipes throughout the system, many installed before the Great Depression, cracked and lost pressure. There was not enough water to flush toilets or fight fires. This happened in the capital city of a state. It was not a natural disaster. The EPA had issued a warning in 2020 that Jackson's water system presented an imminent and substantial endangerment to those it serves. 2 years before the failure, the Brookings Institution traced the failure to decades of deferred maintenance compounded by state disinvestment, a pattern in which the city could not generate enough revenue to maintain its infrastructure, and the state consistently declined to provide the funding that would have prevented the worst outcomes. Infrastructure repair costs have been estimated at approximately $1 billion. The state received $75 million in federal infrastructure funds at the time. The math is the math. Mississippi's public pension system is 56% funded, the fourth worst in the country, with $9,033 in pension debt per capita, according to Reason Foundation's 2025 report. The state cut personal income taxes starting in 2024, a policy calculated to result in nearly $2 billion in lost revenue over 5 years, according to the Center on Budget and Policy Priorities. Mississippi's governor has publicly called for eliminating the personal income tax entirely, a move that would remove approximately 30% of the state's general fund revenue. Mississippi has the lowest median household income of any state, the highest poverty rate, and it is simultaneously cutting the revenue base that funds the services its population depends on most, while carrying pension obligations it cannot fully fund, in a state whose capital city is still working through infrastructure failures that were documented decades before they became national news. The collapse in Mississippi is not quiet because it is hidden. It is quiet because each problem has been covered as its own story: the water crisis, the pension math, the tax cuts, the poverty, the infrastructure gap, when they are the same story. What happens when the structures that sustain a society are underfunded long enough to begin failing visibly, and the response is to cut the funding further? Living in Mississippi is like living in a house where the foundation is cracking, the pipes have been failing for decades, and the management committee just voted to reduce the maintenance budget. And the house is a state. Subscribe and check out the rest of the series, the counties, the cities, the states, where the numbers say things that the politics has not caught up to yet. Thanks for watching.